So we're very glad to have Anthony Cohen. He's the Asia Pacific product specialist of CQG to give us the cross-market arbitrage opportunity analysis of PTA contracts and relevant contracts. Just a brief introduction of Anthony. Anthony currently holds the position of Director of Customer Support, Europe and APAC. He joined CQG's London office in 2003 as a client support specialist. In 2008, Anthony was transferred to CQG's Singapore office and built out CQG's client support and product specialist function in the APAC region. Anthony has over 20 years of industry experience in working closely with a full array of financial institutions, including hedge funds, investment banks, industrial corporations, financial commission merchants, and he holds certified STA diploma from the Society of Technical Analysts. Okay, let's welcome Anthony. Anthony, oh great, so you're online. Okay, put you in the center.
Hi, can you hear me?
Yeah,
okay.
I can hear you.
Let me share my screen. Okay. So, hi everyone. Let me just make sure this is displaying correctly. Okay. So, what I'd like to do now is take the opportunity to show a more technical aspect of the PTA trading. I will start with a little introduction of our company. CQG has been in the market for 40 years now. We are connected to several exchanges worldwide and redistribute market data for more than 100 exchanges and have connectivity to more than 50 FCM partners at the moment. Our clientele is split between hedge funds, investment banks, trading professionals, and prop trading groups. What we offer is a tool that allows FCMs to manage their risk and create their accounts in our platform, but also to have the traders run analysis and trading using our market data for the several exchanges. So we'll see that this is pretty important in PTA as well as other things, which will show you how to use many data sources to be able to run arbitrage and different trading opportunities. What plays a big role in the arbitrage aspect is the connectivity. We offer access mainly on a direct basis. So you'll see the list of exchanges here showing the main exchanges that we have access to, as well as a indirect basis through a specific partner for the onshore Chinese market. This network is fully managed by CQG and is aimed at offering traders the ability to do low latency trading. This is key when you try to do arbitrage, and we'll see that a little bit later. So basically trying to lower the latency between exchanges and between servers reduces risk and also increases profitability. To do that, we have several products that allow you to place orders. What I'm going to focus on today is what we call CQG Integrated Client, which is the basis for CQG Spreader, but also the integration with Excel, which we'll see is pretty important for certain spreads. So we also offer, in terms of analytics, we offer different types of charts and other tools that will allow you to develop models and find the right information needed to gain access to a good arbitrage opportunity. So the main tool that we're going to focus on today is the spreader, and it's trying to obviously show you how you can build a spread to take advantage of a collocated network to work your legs into the market. So there are going to be a lot of parameters that are going to be very important when it comes to running the spread and doing the arbitrage between those exchanges. So obviously the previous presentations were a lot more fundamental than that, but what I'm going to show here is obviously trying to look at the PTA process, transformation process, to try and find out what we can use to have an edge on the arbitrage side. So obviously the correlation here, or what we're going to be looking at, is going to be focusing on crude. We'll see that crude and naphtha basically have a very strong correlation. PTA and PX also have a strong correlation, obviously. But the fundamental is that currently, because of the slight lack of liquidity on the PX side, which is not impossible, but what we want to try and focus on, and based on the volume analysis that we can see now, is that, not sure if this is very clear, but we can see at the top left the price of crude oil, WTI, and obviously displaying a very high volume and obviously very high liquidity. At the top right, we'll see the PTA price and the liquidity that it shows. So there's quite a lot of volume on those two particular products. And at the bottom, we will see the PX. Bottom left is PX, and then bottom right, you'll see the naphtha. So what we're seeing here is obviously a low liquidity aspect of the naphtha and the PX futures. So that's why one of the good things to do is to try and arbitrage something to begin with higher liquidity. So we're going to try first to look at the relationship between crude oil and PTA, and we'll then move on to something a little bit different. So crude oil and PTA, even though they're not really obviously next to each other in the chain of transformation, we know that there is an obvious correlation because of the whole process. And what I want to try and do is to begin with, because of the fact that there is a a few processes in between, we have to look for the best way to analyze that correlation. So what I did there was to look at a proper correlation analysis between the two products. So crude oil on NYMEX and TA, which have turned into dollar per metric ton. And I've looked at how those two products correlate over different time frames and different number of bars. Now, what we can see is that the top, the figure 1 chart shows us the current value of that correlation. So obviously what we're trying to find is a higher correlation, which will be highlighted in blue, which will show high correlation. The red will show decorrelation, and the white section will show uncorrelation. So what we're seeing here basically is that the daily chart, whether we're looking at 2-bar or 20-bar correlation analysis, are not really showing promising results. And there is a good reason behind that, but we'll see that literally just after that. So what we're trying to do is we need to go down in time frames to find more relationship between the two. So the lower two charts show a moving average period, which gives us a slightly better analysis to show us that this particular correlation is a little bit more confirmed over a few bars back. But what we're seeing here is basically that in order to find something to work on, we're going to need to use lower time frames between, I would say, 1 and 5 minutes to be able to find a little bit of profits. Now, why this isn't just as easy as putting this on a chart, there is a huge difference between the two contracts. Obviously, we're looking at two contracts that trade in different currencies, but specifically they trade at different times. The WTI trades 23 hours a day, whereas PTA trades into smaller sessions, which are split into 4 smaller sessions. So what that means is that the correlation is very difficult to find, because between those respective sessions, we're going to have a WTI move while TA is closed, and that causes gaps and obviously differences in analysis. So to be sure, first of all, that we analyze something that can be analyzed, we have to be sure that we only analyze the two data series while they're trading at the same time. Obviously, we're not going to use a price of WTI while the TA is closed, otherwise it'll just skew the whole analysis. So we can see that there are slightly longer periods of time on the TA side between 9 p.m. and 11:30 p.m. So that's a slightly longer, that's the longest session for it. The morning, the afternoon, and the third session for TA are slightly shorter, but they are actually quite interesting. And the reason is, when looking at the analysis of these particular sessions, so we're looking at the 9 till 10:15 and the 10:30 till 11:30, even though it's only a short close between 10:15 and 10:30, we still want to be sure that each short session is analyzed individually. And what we find is that there is a higher correlation with WTI during those two sessions rather than the afternoon and the evening sessions. Given the time zone and the aspect of time in those particular products, it probably is related to the fact that volatility of crude is a lot lower during Asian hours, whereas between 9 and 10:30 p.m., which is very it's bang on during the US session, and especially during release of figures time, it's basically very volatile, and the correlation might be affected at that time. So we find that even though we can try to arbitrage any of those sessions, the most stable one is the 9 till 11:30 session. So what we're doing here is that we are going to use the spreader, CQG spreader, in two different ways to begin with, to try and set up a spread that will give us a little bit of an edge. And the way we do this is that we need to create two components of that spread. Obviously, given that the two products are trading in different currencies, we will need to create a first spread, which I've labeled here as PTA in USD, which speaks for itself. We're just going to take PTA, turn it in USD, and this will be our first spread. And this is done in CQG spreader through the chart that you see now. And there are a few parameters that are going to be extremely important here, and especially for any of the Chinese markets. So we can see, first of all, how we want to work this particular spread, so how many lots we want to do on both sides. And there are two ways to work on this particular market. As you can see through this particular example, we can allow you to execute on, obviously, TA. So we're going to have a size going through for the execution of PTA. And ZUC is what we're going to be using, which is the SGX CNH futures, because we have to actually at the moment have to use the derivatives to do the hedging or the price conversion. So in this particular example, I am using a zero volume for the CNH simply because I don't want to be hedging on that side. But if I wanted to, I could just simply change that volume to any number of lots that I want. Obviously, it would have to be reflected in all of the legs and the rest of the spread to be sure that the contract sizes match and give us something that's giving a proper hedge. So here we have a 1 to 0. So one lot for PTA and 0 for the FX. We can check the hedge type. So that'll give you, obviously, the ability to change whether you want to send orders as speculation, arbitrage, or hedge. That will depend on your type of trading. Obviously, this is all dependent on the firm that will be trading that. What we're going to be sending when the first leg is completed is we're going to complete that spread with a limit order on TA. Since there is zero volume on the FX, then I'm not executing anything, but I could also check it if I was to hedge with ZUC. And then for so this was the first part of my spread. And what I'm going to do then is I'm going to take this PTA in USD and I'm going to spread it against WTI. So I'm obviously using a spread ratio and price ratio, which was described earlier. And what we're doing here is, as you can see now, this PTA in USD is one of my legs, and I'm going to spread that with the CLE, CLE being our symbol for crude oil on NYMEX. So I'm going to execute one side and then against one lot of WTI. Again here, obviously I'm going to be matching the same type of hedge type. Here is speculation. But in this particular example, we're going to work the CLE leg, which is meaning that we're going to have orders literally in the market on the WTI. And once this is done, once this order is done, we're going to hedge onto the on the PTA in USD. Now, because those markets at some points can be fairly liquid at times. If you are doing a little bit of size, because the PTA side requires a lot more lots compared to the WTI, given the differences in contract sizes, we can actually use different price levels to look for the remaining volumes. So we don't really necessarily have to look at the offerings on the best bid and offer. We can actually go a little bit deeper into the market. And the last part of the setup of our spread is the active price range. We have a lot of, I would say, traders that are a bit worried about the number of orders that are being sent to whichever exchange nowadays. There is a lot of steps that are taken to try and reduce the number of transactions. So what we can do is we can actually offer the opportunity to lower the number of messages and even not work that spread if our order is too far away from the current market price. So the active price range is something that's your friend here to try and please the exchanges. And the last part is what we do in the event that we get legged out or an incomplete spread. What we call legged out is obviously we are executed on one leg, but when the time comes to execute on the second leg, the price that we originally wanted is no longer available. Therefore, the system can take over and say, what do we want to do? Do you want to go into this manually and move your price and try and get filled? Or do you want the system to take over and pay up? And how many ticks do you want to pay up? So this is the sort of automation of the closing of that spread. So because the market is closed, but I wanted to show what it looks like and what the opportunity is like, I did a small recording of this particular market. So we're seeing it here. So on the left, you'll see the crude on PTA, and it will show that we are working the CLE leg, meaning that we are going to have an active order in WTI. So actually, I'm placing I am placing a bid and an offer on the spread this will show me a bid and an offer on WTI, which is the CLE leg that you can see over here, which correspond to the prices that would show me a differential between the other two leg and my spread price. So right now I can see the best bid and offer of that spread over here, and I'm trying to move my orders a little bit closer to the market just so that I can see what would happen. Because I am not hedging on the ZUC, which is the FX rate, when I get filled, I'll only see the crude and the PTA positions, and I should see zero position on the ZUC side. If I was to actually hedge through ZUC, so as you can see now, I got filled. I'm short crude, and I'm long the PTA, but I've got zero position on ZUC. If I was to hedge, I would see my position accordingly. Now, what we can actually see through this particular product is that, this is a test account, which shows obviously a unique account, but the technicality behind this is that CQG is a multi-broker and obviously multi-exchange platform. Given that you would need obviously an account to be able to trade PTA, but also an offshore account to trade anything offshore such as WTI or any other international exchange on the other side of PTA, you would be able to spread exchanges through different accounts and through different brokers. So obviously Nanhua would be one of the sites for the PTA, but you can have another broker to have the other side for the WTI. This is completely fine. And the whole process behind this particular spread is all done on our collocated servers. So this is pretty much where the magic happens. We'll have that working server against server and trying to reduce the latency between all these exchanges. Now, still using the CQG spreader, what I would like to show is that obviously there are cases when certain legs might not have enough liquidity. In this particular case, we have NYMEX WTI and ICE WTI. They do have a lot of liquidity, but at some particular points during the day, especially at the start of the Asian session, the liquidity can go down. And if you do enough size on PTA, you may want to be sure that you get a better bid and offer. So what we can show here is one of the other components of spreader, which we call aggregator. And what we do here is that instead of only using NYMEX WTI, we can aggregate NYMEX WTI and ICE WTI into one product and spread that against PTA in USD. So that's basically mixing a lot of particular different products on different exchanges. So you notice that ICE and NYMEX are different exchanges, but we'll still be able to gain try and potentially gain a better price on those particular exchanges. So that's in itself tries to give us a little bit better liquidity. And it also allows me to do a choice of preferred market. So I can choose to prefer the NYMEX over ICE or the other way around. But this is just one of the examples of products that we can choose. As we will see a little bit later that when the time comes that potentially the PX will become available on the ZCE, and the fact that it is also available on SGX at the moment, you'd potentially be able to aggregate those two as well later on. So this particular aggregator will come handy potentially in the future when more products are trading on ZCE. But at this time, what we're seeing here is that we're looking at potentially the same spread, but and you won't see very much in the background, but you could see the way that I could actually work this particular spread. I can work so I'm currently working the best out of the crude on WTI on NYMEX and WTI on ICE. And when that is done, I then go on to execution to PTA and potentially the ZUC if I wanted to hedge on the FX side. So there are a lot of potential for that spread. So the next and the last thing that we can look at, obviously in the same chain, is the relationship between PX and PTA. So we see that this spread is very important, and the correlation is even obviously higher than the one with crude oil and PTA. But as I mentioned earlier, currently PX is very illiquid on the SGX side, but yet it does not mean that we can't use it because the relationship is there. We can make use of that price one way or the other. So we're going to look at a different way to trade this on our system. So historically, we can see that there's a huge relationship. So you'll see the actual spread price onto the left and deconstructed one on the right. From research, we can actually find that a spread price below $85 or approximately is considered unhealthy. And we can actually see that it is indeed unhealthy, but we can actually see that there is a little bit more to be taken from that. So using a distribution chart from Market Profile for that particular spread, and basically looking back, I would say that's October 2014, which is as much data as we can go back in here, we can see that the distribution since then has been concentrated between $134 and $256 approximately. So that's what we call the value area. And the point of control, meaning that I would say sort of most adequate price is around $195. So this particular chart is pretty important when it comes to the arbitrage of that particular spread, because it shows that anything outside of that is, I would say, fairly interested to try and catch, but it's unfortunately prices that are considered rejected. So we can see at that particular point below $134, not much activity and completely rejected prices. On the upper side, it's a little bit different, but still, it's very difficult to profit from that particular spread at those points in time. So, what you can actually do here is use I would say biased analysis of the particular spread. So what we're doing here is something more on the market making type of trading, whereby we take the price of PX, which does not move a lot yet, obviously, but because we know that this particular spread being at a certain level is considered bullish or bearish. So on the example that I'm going to show now, which is also a recorded video, just to show you a little bit of how this works, what we're doing is we're making use of Excel to provide the order prices to CQG so that CQG can place those orders. So I'm deriving the prices, the buy and the sell prices of this particular spread using Excel, and Excel is feeding the price to CQG. So I'm entering my buy and sell levels into Excel. Excel then displays those levels on my chart, and you'll notice that, so obviously PTA trades in different increments of 2, but because the result is due to maximum deviation, which is averaged out, so CQG will display the buy level at 37.37 and the sell level at 37.99. But obviously the prices, when they go into the market, and you can see then onto the ladder, they will be rounded to a tradable price. So essentially what we're doing here is we're telling CQG which levels we want to not only display on our chart, feeding via Excel, and then from the chart, we're going to display those levels onto our ladder. And from the ladder itself, we're going to simply right-click onto those prices and place the orders following that. So what I'm doing here simply is linking the two together. If PX was to become a little bit more active, those levels would be able to move accordingly. I wouldn't really need to touch anything. At the moment, they're not really moving due to the low liquidity, but this is a simple process that will allow us to take advantage of that spread. So what we're seeing here is trying to obviously take advantage of so we're looking at a bias on the bullish side because of the price of that spread. So we could take a long position at the cross of the lower band. So this is using basically a mean reversion strategy to try and take advantage of that. So just to go back to the previous slide, we're trying to obviously try and be on the buy side of that spread whenever it's lower than a certain level, and potentially take the sell side of it when it's on that side. So this is the type of strategy that we can use on the PX versus PTA. So obviously, as I said, that PX PTA spread is going to be a lot more interesting if and when PX becomes available onshore. There'll be a lot of opportunities not only for the onshore offshore PX, but also, as I said, an aggregation between the two against PTA. We do offer something I've not really showed today, but we do actually offer some options trading as well. And because of Excel, we can actually do some sort of arbitrage through Excel as well. Just the same way we can see there, we just feed the prices into Excel, and then Excel can either send the prices back to CQG or work the orders directly into Excel and send them to the market. That concludes my session. If you have any questions, please let me know. I'm also showing the QR code for CQG China. And this is it.
Okay. Yeah, thank you, Anthony, for the comprehensive analysis. I think it's an eye-opener for me. And I think your sharing is quite... Anthony,
Yep.
you may want to... Oh, okay. So, and I think it's very interesting to understand the arbitrage theory, arbitrage opportunities across markets from U.S., for example, crude oil, to Singapore, to China, PTA futures, as Singapore with these FX futures. So, and I think it's also quite practical for the traders who want to do the cross-market trade, people who want to do the cross-market trading. Maybe CQG with your office in Singapore, in China, in US, can you give us some opportunity? Give us some example of how you can help your clients to trade, access to this market, to China especially.
Yeah, so we have obviously CQG being originally set up in the US. As I said, 40 years ago, we have accomplished quite a lot on the American markets and established very low latency connectivity. And we have recently not only started but reinforced our presence within China. And our connectivity is based on trying to get our clients the best execution and the lowest latency. So we offer a wide range of data sources, and our clients can also open accounts very easily between different brokers. So as I explained earlier, we have so the clients will definitely need potentially to have accounts at different brokers to be able to do the onshore and the offshore access. So we do provide a wide variety of exchanges and FCMs that are partnered with CQG. We make it as easy as possible for the client to trade from the one platform and to avoid having to source out different data feeds, etc. We basically gather everything. We manage it all, which makes it more interesting. Okay.
Yeah, and also I saw some questions here, but I think you mentioned earlier you can provide some you can provide arbitrage and also options trading, right? You can facilitate arbitrage and options trading.
So arbitrage and options. So yeah, we do offer arbitrage. We do offer options trading. And as I said, yes, this is the aim of everything. This and what we've spend a lot of time and efforts is to try and make the infrastructure as efficient as possible to try and make this possible and more profitable to the client.
Okay. Yeah, there's one more question. I'm not sure whether you can give us some idea. Darren asked, does the PTA crude spread exhibit any special behavior at the 9 a.m. Beijing open of PTA and the approach to the close at 11:30? You monitor
the spread itself is obviously going to show specific behavior at 9 a.m. because of the gap between the previous close, which is a few hours prior to that Beijing time. So there's going to be a gap, obviously, and there usually is a little bit of volatility there, which kind of seems to slow down very quickly. However, at 11:30, there doesn't seem to be much. It seems to be pretty stable. So I've not seen anything that earth-shattering, except obviously for the gapping due to market hours.
Okay. So I just now I asked the earlier speaker Diana about the outlook, the impact she think about ZC's planned futures launch, a PX futures launch, and several other new product launch. What do you think the impact the PX contract ZC plans to launch will have on the liquidity of the market from the provider's perspective?
Well, our customers are very eager to find an arbitrage. As I was showing earlier, and this is not obviously just limited to PX, SGX is quoting a few other products that might find their counterpart on ZCE, and it's going to be a good source of potential income for some arbitrager or market makers. So it's going to be a very interesting addition. Especially because there is something else trading of that same nature in Singapore.
Okay, excellent. Thank you. I think we learned a lot today from your presentation, and I hope that the audience here and will be given more opportunity to trade to China, especially these PTA futures contract, and there will be more arbitrage opportunity across market, across products. So thank you once again, Anthony, for your analysis and excellent presentation.
You're welcome.
Okay, time. Time flies. So it's already 5:20 in the afternoon. We have already spent together more than 2 hours today. I mean, I'd like to take this opportunity to thank again the organizer and supporter, all the speakers, and as well as the audience here to spend the afternoon with us, join the Trading PTA webinar. Thank you so much, and I hope you enjoyed the session and have some useful takeaways. If you have any further questions, please do feel free to email to the speakers, to the organizer, the supporters. If you have any, or you can contact me if you forget the email address, I can link you up. So do stay in touch and stay well, stay safe in this COVID-19 arena. Hope we can meet again, perhaps virtually. I just show you a small information. FOW has an upcoming event in September. It's also a virtual event, but it covers wider content on Trading Asia. It will be held on 17 and 18 of September. Hope we can meet there, and better, very soon we can meet physically. So thank you so much for being here.